Next topic, syndicate versus fund dynamics. I'll start off with this and say it is categorically not correct to say that the syndicate structure or the fund structure, one is categorically better than the other. I think each has its own merits, and for us, it's better to understand the economics or the characteristics so that we can play the game that to your advantage. So I'm going to be sharing this and talking about the different characteristics and the pros and the cons so that you can understand these dynamics. And we break this down into 4 different buckets. The first one is capital availability. If you're running syndicate, the capital that you have availability is going to be a function of the number of investors in your network, their engagement level, however you quantify that, and their average check size. Those are your levers. On a fund, it has to do with the fund size, how much dry powder is left, which is not deployed capital, or maybe exit liquidity. If you're exiting a position and getting something back, you get to recycle that capital. And beyond that, it's maybe follow-on funds if there's something being planned. For capital allocation, in a syndicate model, investors make their own investment in capital allocation decisions. The decision control is taken away from syndicates and given to investors. So this is a very specific dynamic to this vehicle, and also one of the challenges which we need to solve. On the other hand, with a fund, once it is raised, they control dry powder, they can make capital calls, and so those decisions are made by funds. The next is scope and flexibility. A syndicate plays a market maker role, and so you have the ability to pursue opportunistic deals and evolve your thesis. On a fund, it's pretty tightly governed by a fund mandate, so your ability to flex, to change, to do certain deals outside the scope is quite restricted. I think these things matter. On a syndicate, you theoretically could do a biotech deal one day, a consumer play another day, SaaS another day. And I'm not saying you should. You absolutely should not, by the way, but the flexibility is important to evolve your thesis, especially in response to market conditions. The final thing is the economic structure. With a syndicate, we have a fee structure. There's carried interest. It does vary syndicate by syndicate. Whereas on the fund, there's a classic 2 and 20 fee structure. So 2% management fee a year, 20% carried interest. On a syndicate, we don't ever see return hurdle rates. And in funds, it is fairly common. I'd say 60 to 70% of funds will have a return hurdle. And typically it's between 7 to 8% a year of capital that you need to return to investors before carried interest applies. And the third difference is deal level carry in the syndicate model versus portfolio level carry in the fund. Now, one thing I do want to address head on is this idea of power law and why it's a bit of a VC centric view. Okay, and the perspective is a little bit different for angels and syndicate. So I want to elaborate on that. I'll articulate my reasoning here. So if you're not familiar, power law is basically the 80-20 rule, right? We're saying that very few companies on the left return a very high multiple return, and then there's a very long tail that returns very little or outright go to zero in your portfolio. It is absolutely true as a law of nature, as a mathematical construct, right? In any portfolio, you're going to have this return pattern. But power law applied in VC is a bit specific, right? Power law in VC is making the argument of diversifying and investing in a lot of venture assets in a bid to get a lot of these outlier returns. So here's why I disagree. Power law is a VC-centric view. Nothing wrong with it. I'm just pointing out what this is, right? And it differs for angels and also syndicates. Number one is economic incentives, right? As in life, as a general principle, economic incentives drives a lot of behavior that's very natural. The VC business model rewards fund managers on upside. So more bets increases the odds of 100x returns. So they incentivize to invest in more. Second, there are diversification trade-offs. If you want to do parallel, which basically in VC argues, invest in a lot of venture asset, you're also required to scale your deal flow, your time and energy to be able to process that deal flow, and your expertise to make good decisions at scale. Otherwise, you have to make compromises and trade-offs on the quality, right? It's not a free trade. Just because you can deploy into more companies doesn't mean that the quality stays high. This is a very hard problem to solve. Next, leverage. In a VC fund, there's a concept called paid up capital. This is the amount of contribution from the partners to show skin in the game. Typically, that's 1 to 2%, which basically means that on a VC fund, the VCs are able to lever up 50 to 99 times on investor capital. They get to amplify the upside with carried interest. Investors, on the other hand, individual investors have zero leverage, so the failure cost is more expensive. And finally, for syndicates specifically, every SPV, the return characteristics resembles a call option. This is because of deal level carry, right? So you get 20% carry above 1x on every deal versus portfolio carry for funds, which is 20% carry above 1x on the entire portfolio. To put this into numbers, what would this look like? Let's do an apples to apples comparison. This data set here, this histogram is showing historical VC capital return patterns in the US for 2009 to 2018. The data says that on average, 50% of capital deployed by VCs in the US during this time period returns less than 1x. 30% returns 1 to 3x. 9% returns 3 to 5x, and so on, right? So we see the long tail pattern in the aggregate on the industry. If we deployed $50 million into this portfolio, it means $25 million into the first bar, $15 million into the second bar that returns 1 to 3x, and so on and so forth. The apples to apples comparison between the fund and syndicate, assuming identical portfolio. And to be clear, I'm acknowledging that this is an assumption. But on this portfolio, we're saying that $50 million of capital deployed returns $150 million, which generates $65 million profit. Now, on a VC fund, a straight 20% carry generates $13 million. If the fund had a return hurdle of 7% for 10 years, in the very worst case that you take $50 million deployed on day one, don't return capital for 10 years, the return hurdle compounds. And after 10 years, it actually becomes 97%. And this would diminish the carried interest to 3.4. This is, of course, a completely realistic extreme scenario. It just would not happen. But there is a time scale element here which is unpredictable, right? So what I'm illustrating between 3.4 and $13 million is the extreme outcomes. All we know is that the number will be between these two things if there's a return hurdle at play. On a syndicate, on the other hand, since there is deal level carry, any portfolio that returns less than 1x, this first row, we carry a 0 here, right? There isn't a negative on the balance sheet that carries through. All the other deals that we do that return above 1x, you get 20% off the top. So in this case, the syndicate would clear $15.6 million in carried interest, assuming identical portfolio, which means to say, because of deal level instead of portfolio carry, there is a $2.5 million carried interest advantage for the syndicate lead. If there is a fund 7% return hurdle, there's going to be another delta of plus minus 9.7 million, somewhere in this range, depending on timing. Okay, so here we're just quantifying the mechanics of deal level and portfolio level carry on an identical portfolio.